I give it an 80% chance right now that we're going to see another increase.
So you think rates could go up by end of the year?
Yeah,
So no.
absolutely. I definitely.
That's cool.
Yeah.
Gonna start eating crackers now. No more grocery. So, as everyone heard, today the Bank of Canada held the rates, and we said that in reality check, that's what I thought they were gonna do, although inflation was high. But what happened was they held the rates. So I'm here with Jordan Lee from Vine Group. She's a mortgage broker, and we thought we'd bring her in to see what she thinks of the rate hold.
So there's a lot I have to say about the rate hold. Of course, it's kind of a neutral position with them holding interest rates. It didn't go up, it didn't go down. We're holding at 5%. Now, there's a lot to unpack with that. Why did they hold interest rates today when before the GDP announcement last week, there was actually about a 20% roughly economist forecast that we were going to see a quarter-point increase on this one. When GDP news broke last week that it was a lot tighter than we anticipated, there was a 7% chance that we were going to see Bank of Canada increase. So last week, let's go back to the GDP.
Yeah.
The GDP news, essentially what that means is that our economy growth is a lot smaller, has contracted, which is great news for our economy. Technically, that's our goal. And we saw it at about 0.2%, where the forecast was at about 1.5%. So that's huge. That means our economy is growing a lot slower and at a lot less strength than it was previously and a lot less than anticipated, which is going to be good news as our economy continues to pull back. That's the goal of Bank of Canada. The only thing that I think the reason people thought Bank of Canada could increase is because of the inflation numbers having increased the month prior. So that's a big number that we have to watch out for. Inflation is likely to continue to increase, unfortunately.
Yeah. So I have an issue with the inflation because one of the metrics in there is gas prices. They haven't dropped down, and I don't think they're going to drop down. And the second thing is the grocery. Like these things have been rising, and in my opinion, that's not a good reflection of what's happening in the economy.
Exactly.
So that's my personal issue with inflation. But does this mean the rates will not go up? Because I have a feeling interest rates could still rise, and the reason for it is the two metrics we just talked about, the GDP and inflation. And the inflation, if it keeps on rising despite the GDP, we could see another rate hike, which we actually have two more rate announcements. I don't know why everyone was so excited about the September 6th. This is not done. Because I always was saying, even if they don't increase it right now, they still got two more chances by the end of the year to increase it. So we got September and December, if I'm not mistaken.
October 25th, and
October
then
25th,
December 6th. So every 6 weeks we have these announcements. The good thing about October 25th is that's the one that comes out with the monetary policy report. So we'll actually get more information. This interest rate announcement was really just simply an announcement. It doesn't really give us a lot more information to work with. But one thing is very, very clear. The Bank of Canada has always made it extremely clear that their only goal is inflation. They are not taking any consideration to the housing market, the impact on consumers. It's literally just inflation. Their goal is 2%. Now, the scary thing that happened in the last interest rate announcement is they started to talk about 2025. Every other announcement has always been that we were on set to see inflation come down into our 2% goal by 2024. Now it's 2025, but I think there's reason behind that because like you said, it's really headline inflation that's continuing to increase, and that's driven by living costs, obviously, because if we continue to increase interest rates, of course people's living costs are going to increase, and then we have groceries and then gas, of course, and we are seeing both of those take monthly increases month over month. So those numbers are going to greatly impact. I wouldn't be surprised, now don't quote me on this, I just wouldn't be surprised if we see inflation tick back up to the 3 to 4% range. And with that, there's likely going to be another quarter-point increase. I give it an 80% chance right now that we're going to see another increase. Which one, or it could be both actually.
So you think rates could go up by end of the year?
Yeah,
So
absolutely. I definitely.
That's cool.
Yeah.
Gonna start eating crackers now. No more grocery.
I definitely think that, unfortunately. And so.
And that's because of the inflation rate?
Yeah, because of the inflation.
And I don't know, when is the next GDP announcement?
I don't know when that is actually.
So, I mean, like, again, every quarter, they're gonna announce the GDP, and if it's contracting two consecutive quarters, they call it a recession. Clearly, that was changed last year when the US went through it and they said, oh, no, this is not a recession. We're gonna drive this economy to the ground, then we're gonna call it recession. But So we gotta see what happens. So there is still a chance that it could increase, but just gonna say my 2 cents. I personally don't think it's gonna go up.
Okay.
And I actually think in the first quarter they could bring it down. And even if they don't bring down the actual, let's say variable rates, it could be the discounts that go up. This is what I see, and I think this is what is going to happen, like what happened at the beginning of the year when the fixed rates dropped and then the market has started to pick up. I'm just talking about real estate, of course. Market started to pick up, and we saw, I mean, I personally saw 2-year fixed rates as low as 4.79. And but right now we're hovering at what are like 6.5
like
and
6.5 and
yeah, let's not even
right
talk
now.
about that. But as soon as these things get affected, you know, the dynamics of the market will change. But again, I think rates won't go up till the end of the year. First quarter, it could come down, or the fixed rates will drop.
Well, I agree with some of that there. With the fixed rates, I do think there's already room technically for rates to decrease because we did see bond yields shift downwards with the news of the GDP, and I expect that also with today's Bank of Canada announcement as well. So there is room for rates to kind of trickle down. I don't think we're going to see anything major though. I think just like in the beginning of the year, like you mentioned, we were seeing promo rates, exception rates. These were not posted rates anywhere because the bank never knows when they're going to have to pull that back. They won't do pre-approvals based on those lower promo rates. They'll kind of offer it on the accepted offers, the live deals, because they want to capture as much business as possible, but you're not going to see a lot of those on the rate holds. Right now, we are sitting around 6 to 7% depending on your term, like from 1 to 5 year. And I think that the variable is going to be a big conversation as we shift into the new year, as we shift into the end of 2023, because that's where the variable allows you to kind of play with the market, and when interest rates come down, your interest rate and your payments will take the benefit of that depending on what bank you're with. But I do think the variable poses a big opportunity right now, and we're shifting further away from those 3-year, 4-year, 5-year fixed terms because those are just too long with what we're anticipating from the economy. And just like a little insight on where economists expect rates to go.
So the forecast from the banks.
Yes, so the
Let's
bank
hear that.
economists. A lot of the banks actually expect that we are going to hold all the way through. CIBC is the only one who has another quarter point increase factored in for 2023 Q4. And then in 2024, that's when all the banks have anticipated rates to come down.
So just like me.
And Q2 though, not Q1.
Yeah, Q1. Yeah, I think Q1 it could come down, but I could see it happening after on April, May.
Yeah.
But
exactly, our spring market time.
Yeah, that's again, oh my God, if it comes down during the spring
gonna be
market, I
nuts.
just realized how nuts that's gonna be.
That's it.
But with the actual fixed rates, again, like what I see with these banks is at the beginning of the year, we had the bonds drop down when we had the banking crisis in the US. But the fixed rates didn't come. So I waited like about a month and I was looking at it. I'm like, oh my God, these guys are not bringing the bring the fixed rates down.
No.
Well, the bond rates dropped within a matter of a week, by like over 1%, 1.5%. So with that, I mean, again, I don't like, clearly they will not adjust as quickly as the bond rates.
No, because the cost of funds, keep in mind the bank is also a business, right? So the cost of funds are very high for them as well. They can't overcommit to these rate promos when they have no idea what's going to happen the next 4 months, right? Our pre-approvals and rate holds are typically 120 days. The bank can't commit these promo rates for 4 months out when the economy can do like a whole backflip within 4 months with where we are, right? So that's why they're really only honoring it, and you could have missed it. Like there were so many clients who missed it because again, they weren't holding them, but if you happen to have a live refinance or a live purchase, then we could access those rates. And that's actually a great point that you bring up too. Like if the banks are anticipating in 2024 Q2 that the rates are going to come down and then they're going to start to come down significantly, they've priced in about 1 to 1.5%. That'll depend what that looks like, you know, of course, what our peak is, because if it increases more this year, let's see what that ends up being. But that's going to be crazy. So if rates come down at the same time as our spring market, we're looking at pretty much 2021, 2022 again in terms of like inventory and transactions. So
it will actually, I think, be worse because for the last 12 months,
that's true.
the sale numbers have been drastically lower than the historic average. So that means people are standing on the sidelines.
Yeah, they're stalled.
Yeah, and to add to that, we got a lot of immigration that we've never had before, and a lot of people are still debating whether or not get in the market. So once the rates come down, I've been saying this, I mean, we saw a little snippet of it at the beginning
Yeah,
of the
just
year.
a few months ago.
Yeah,
Yep.
and I've said it before, over 4 months, we had just over 20% increase just in Toronto in prices. No
crazy.
one talked about it, but that's what happened till the interest rates went up. So just imagine what's gonna happen next year. A lot of people are still not buying because interest rates are
Yep.
still high.
Yep.
Another thing I was gonna ask you was, I was always a fan of variable mortgages, and that was just my personal preference, but is it just me, or in the last, I would say, year,
Yeah.
it's more favorable to get fixed? I would say short term, like 2, 3
Yeah, it's only right now because of the security around a fixed term. People, especially your first-time homebuyers who are entering the market, they can't handle that kind of volatility, and I don't expect them to. It's a very, they're taking on a lot of new responsibility, getting their first mortgage, their first home. The last thing they want to have to do is wait and watch these announcements with huge anxiety, wondering what's going to happen to their payments. So you would take a shorter term, fixed term right now to be able to line that up for when interest rates come down. So you would take 2 or 3 years. 3 years now is a little bit long from where we stand, but you are getting a little bit of a lower rate. The 2-year nears 7%. So the challenge with that is the higher the interest rate, the lower the affordability for our clients, and the higher the payments. So I know it may be favorable for many reasons in terms of the economy and interest rate to go with the 2 or 3 year, but sometimes for cash flow and affordability, it could make sense for clients to go with the 5 year.
Yeah.
So it's our job to explain why all these rates, they're very different. You're gonna see a huge range of different interest rates and flexibility, but they each have their pro to them. Even the 5 year, people are saying that it makes no sense to go with the 5 year because you don't wanna lock in for that long. I get that, 100% agree, but ultimately, if our client can't afford our payments, it's living in the payment.
Yeah.
The interest rate means very little.
Yeah.
It's about the payment. So
Yeah,
I
it
think
is.
that's where the 5 year still plays a role here.
Good to know. So assuming right now we're working with a lot of buyers, and if someone is getting into the market, we always tell them, we don't even take clients out unless they're pre-approved.
Yeah.
But what should one do if they're looking to purchase now? What would be your suggestion?
100% you need to do a firm pre-approval, and when I say that, it means that it's someone who's taking your documents and checking your credit up front. I know that's the least favorite thing for clients to hear. They love the mortgage online calculators, and they love the guy who will pick up their phone and do this little assessment while they're on the phone. That is not a pre-approval, and I cannot caution clients enough against those. You need to have an actual pre-approval, all documents up front, credit check, and that means that when you actually go purchase, you can purchase with confidence. We've checked everything out just like the big banks do. And we also are going to do a rate hold for you. What that means is that we'll hold our interest rate for between 90 to 120 days, depending on the bank. And you're able to shop and close within that time frame, and we'll honor that interest rate. If interest rates are better anywhere else in that time frame, we always can pivot. It really acts as your worst case scenario, so it puts clients in the best and most confident buying position.
I actually want to add something to that, because you mentioned, okay, it might not be favorable to you for the mortgage broker to run the credit. No, it's actually, in my opinion, it is to your benefit, because if you're gonna get the mortgage anyway, unless you're just sightseeing, if you're getting the mortgage, you want to know exactly how much you can afford, what your payments are. So many times people are saying, okay, you know what, I'm pretty sure I can get $1 million mortgage, but then they see the payment, they're like, okay, let's hold, let's drop that down to 800,000 because the payments get crazy, and depending on level of comfortability you have, and also your lifestyle, these things are important to do. Last thing I want to add is what this recent rate hold means to the prices. So, for the last 60 days, we've seen prices drop. And again, for those who follow me and have watched Reality Check, we talked about it back in May. May essentially was the peak of the market, in my opinion, and it is going to be for 2023. The lowest point of the market was January. We were hovering at $1,039,000, $1,036,000 average price point. So I don't think we're gonna see those level of prices, but I think one of the lowest price points we're gonna see is going to be August and maybe September, because these are gonna be a little bit iffy, because September, a lot of people, the first week is completely gone because of the school, and pretty much you have about 2.5 weeks to go house shopping, so the sales figures could be low. But I don't see prices going forward come down for the remainder of the year, and the reason for it is the recent rate hold. Again, keep in mind we have 2 more rate announcements. Things could change, but if you are in the market to purchase, in the next 12 months you're planning on purchasing, I don't think there's going to be a better time than to do it right now.
Couldn't agree more.
And although the rates could be high, the savings you are going to have in any market, and I'm talking about, we've studied markets all the way from Newmarket, gone all the way to Oakville, and on the east end, we've gone as far as Oshawa. Majority of the markets are seeing their lowest price points that they've seen in the last, I would say, 10 to 12 months. And if you are in the market to buy, there is a lot of inventory. A couple of things I want to add, especially for the investors. If you're in the market, condos are a great buy right now because the inventory has gone up and there's good amount and selection. We haven't hit buyer's market, but we're in the balanced market in the condo market, which we rarely see. Second is assignments. There are crazy deals out there for assignments. And again, this is not to take advantage of someone, this is to actually help someone. Someone that bought something may not be able to close on it, you're helping them, you're also getting a good deal. So do not just walk away from assignments, because I know a lot of agents walk away from it because it's difficult.
It's a little more challenging.
To deal with, and a lot of clients don't understand it and they just walk away from it. But we've done some great deals for our clients that they are way ahead. I don't want to throw up numbers, but like it's crazy how much ahead of market they are compared to buying the same thing resale. So if anyone has any questions about how to purchase assignments, how the assignment works and how the financing for it works, you're gonna talk to Jordan about the financing part. But if you want to talk about how the assignment purchase goes, or if you have something that you need to sell on assignment, you can contact us and we will help you understand the process. Anything else we should add, Jordan, before we close it up?
No, I think just to bounce off that same idea is really the concept of date the rate, marry the home. You're dating the rate, it's gonna be short term. You're marrying the home, you're getting into the investment, you're looking at the long-term benefits. The rate is gonna last you, 2 years maximum? If we put you a 2-year fix or even a variable, you're gonna see the brighter side of things sooner than later, but you're gonna have made this amazing investment in a market that we're seeing opportunities that we haven't seen in the past how many years. This is creating a huge opportunity for buyers. If you're able to buy, you can't time the market, but if you can, it's now, if you can buy.
So I would say in the last easily 7 to 8 years, I've never seen an assignment market be in a situation that it is right now. So if you are in the market to purchase, there are great opportunities. We actually have an assignment group. We have an assignment group on WhatsApp that we handpick deals and we put there. Again, you don't have to purchase. If you're interested, you can message me. I will add you to that group so you see what's going on. Again, if you guys have any questions, we're gonna put Jordan's contact information down below. Get in touch. Make sure to ask all the finance-related questions from her. And if you guys have any questions from us, be sure to message us. You can direct message me on Instagram, email me, or give me a call. The phone number is gonna be down below. Thanks for watching, and we'll see you next time.